In the back half of 2020 and throughout 2021, the Federal Reserve supported the economy with unprecedented amounts of quantitative easing. Much of that capital found its way into the securities markets and virtually overnight created superstars of those that took the highest levels of risk. Some of those most emboldened with their recent portfolio successes took to social media to impart their newly acquired level of misguided expertise in a quest for fame and fortune, completely ignoring the fact that the closest they'll ever come to a rigorous financial designation like the CFA is a lifelong membership to the Cat Fanciers Association. And as many of their portfolios have recently blown up, please take a moment to drop a meow in the comments for these fallen angels. In this environment, the principles of value investing were pushed aside to make way for the new, hotter, and much more exciting personalities, some of which were even coronated as the next Warren Buffetts while espousing absolutely none of his values. While this was happening, real value investors were liquidating their portfolios into the strength of 2021 and began warning about the financial storm on the horizon. The media made fun and even began to ask if value investing was finally dead. Then it happened. Predictions of inflation finally came true, and all of the portfolios of the naysayers were absolutely slaughtered. Value investors were once again vindicated, and as we move forward into an uncertain future, it is likely that there's still much more pain on the horizon to those that overextended themselves when times were good. And just like every other stock market recession in history, value investors will be left standing all alone to buy when there's blood on the streets. Cathie Wood's ARK investment sent an open letter to the Fed saying that they don't agree with the Fed's policy of continuing to increase rates in this environment where they're seeing deflationary forces. And that's what I want to cover in this video. So while you guys smash that like button, let me run the intro. What's up, guys, and welcome back to the channel. This one's very interesting because ARK Investments has been on a tear downwards this year. I think they lost like 80% or so. And so I think enough is enough. They don't want interest rates to be increased any more than they currently have in this environment. And so they sent an open letter to the Fed, and let's see what they have to say. Now, I want to keep an open mind. I want to see if I agree or disagree with her. Now, I kept an open mind to Cathie Wood's early in 2021, late 2020, and I concluded that a lot of the prices that she was paying for some of these companies was just too much. And so I decided not to buy into any one of those investments. And I like some of them. Like, I liked Roku, I like Zoom. I just think that the price that she was paying was just too much. At a certain point, you have to consider the dollars and cents, or maybe that's just my bias as an accountant who's also a value investor. So you can see that ARK extended an open letter to the Fed. And effectively what she's saying is that focusing on employment and headline inflation are, in their view, lagging indicators. They believe that commodity prices are the leading indicators, and most commodity prices have peaked. And so I think what they're really arguing for is not additional interest rate increases. And so my opinion on that, and just wrote it here to the side, is that commodity prices are super volatile. I don't think you would want the Fed making decisions using commodity prices. Also, employment data is not necessarily a lagging indicator, as companies make hiring decisions based on perceived strength of the economy. Now, I understand that she's not arguing for the Fed making decisions as commodity prices go up and down. That's not what she's arguing for. But what I am saying is that commodity prices skyrocketed, and just because they're down from their peak doesn't necessarily mean that we're not in an environment where we have inflation. Commodities are still expensive, which has not sort of flown through to the price points for consumers, at least fully yet. Now, I don't have anything to back that up, but that's just what my feeling is. And so I don't know if the Fed is wrong to continue increasing interest rates. My concern, however, and here's where I sort of back Cathie Woods a little bit, is that they might be doing too much too fast and they might overshoot. So the soft landing that they're aiming for, it might not happen. We might get pushed into a huge global recession. So this is where I worry. I almost hope that they sort of like ease off the gas a little bit and see these impacts reverberate through the economy before they keep pressing down on it. So that's sort of like the way I'm thinking here. So, I'm kind of straddling the fence, I would say, a little bit in between Cathie Woods and the Fed. And this is what she's saying. Look, notice how she's saying that lumber is down 74% from its peak. Baltic Dry is down 65% from its peak. Copper is down 31% from its peak. Iron 45%. gold 18, silver 31. So all of these commodities are off their peak. I just highlighted the two that I think are most necessary to build an economy, so lumber and copper. And she goes on to say that downstream inventory accumulation seems to be overwhelming manufacturers and retailers. And she says that in the face of single-digit sales growth, inventories at Walmart and Target increased 25.5 and 36.1% respectively during the most recent quarter. And so she's effectively saying that facing inventory losses, even used car dealerships are likely to disgorge more inventories, which could push price inflation deeply into the negative territory. Now, I agree with her that we do have sort of like an inventory glut right now, but part of that inventory glut, which she's not articulating in her open letter, is that companies specifically bought more inventory because there was the supply chain issue. And so they already knew, and they were going against their sort of like inventory management software just to make sure that there was enough inventory available in an environment where they didn't know whether or not the supply chain constraints would ease over the medium term. And so part of this is sort of like created as a result of supply chain issues and not really like an issue of inflation in itself. Now, of course, there's a lot to argue there, and I do want to hear your contentions to that point that I just made. Let me know in the comments below. We can all learn from one another. And she goes on to say that the Fed seems focused on two variables that in their view are lagging indicators, which is what I described earlier in this video, which is downstream inflation and employment. What she's saying is that manufacturing employment as measured by the ISM Purchasers Index contracted and challenger involuntary job separation soared 67% year over year. So she concludes by saying that could it be that the unprecedented 13-fold increase in interest rates has shocked not just the US but the world and has raised the risks of a deflationary bust? I would say that I would probably agree with her. If they continue on this track, you are going to have a deflationary bust. Michael Burry believes the same, and that's why he was predicting the bullwhip effect. But we'll see how this plays out. This is why I say I do believe that they should ease off the gas a little bit. It's really challenging what they're doing to the economy. And like every 15 basis point increase really takes like a year to sort of work its way through the economy. So, you know, when you increase 75 basis points every 3 months, you have to sort of like wait to see what that'll do, irrespective of what you're seeing inflation do in the short term. But, you know, a lot of people would disagree with me. I'm not an economist, so we'll see how this plays out. And this is what I mean. I think ARC's sort of open letter might be like a Hail Mary because they're down 80% from their portfolio highs in 2021. Now, they might think, oh, you know, this is unprecedented. We didn't expect the Federal Reserve to raise interest rates so high, and that's why our portfolio is down. I disagree. I think the reason why the ARC portfolio is down so much is because they did not pay attention to prices. They did not pay attention to the downside risk. And I think that's where, even in the height of Cathie Wood's popularity, I was saying to everyone that would listen within an earshot that you got to be careful because their valuations are sort of like off the wall. And yeah, you know, if these companies change the world, their valuations are justified, but many of them are not going to change the world. Many of them are going to have blips, and then they're eventually just going to start succeeding on a more like a slower growth trajectory. And so why forecast out high growth rates? And I just didn't see that happening. Now, what does the market look like? Well, look at the Shiller PE ratio. The market is still not exactly cheap. The Shiller PE ratio is sitting at 26.9 times earnings, and the average is 15 times earnings. You could say that in this environment, the average should be closer to like, you know, maybe 17, 18, but it still shouldn't be 27 times earnings. But, you know, we'll see how this plays out. As earnings continue to decline, this might come down even further, but the Shiller PE ratio is just one way of looking at it. The next way is the Buffett indicator. And so the Buffett indicator, once again, is measuring the market value to GDP. Now, this, like the Shiller PE ratio, does have its weakness, but when you look at them together and they're saying the same thing, it sort of speaks to what I'm trying to say, where the market is still somewhat overvalued. So the Buffett indicator tells a tale that the market is still at least one standard deviation overvalued, down from 2. And that's kind of the way I'm thinking about it. And this is what I mean. This is the list of stocks that I'm tracking right now in the tracker that the Patreons get access to at that lower tier of the Patreon. And generally what you would want to see in a market where you're saying that it's somewhat undervalued is that more than half of the stocks that you're tracking are trading at less than 75% of their intrinsic value. Now, I understand that this is a curated list, but it's somewhat curated to be biased so that more names would be trading at under 75% of their intrinsic value than less. And so note, however, that there are 10 names in the work in progress folder, so the WIP folder right now, in that under 75% of intrinsic value group, as I am updating them for the results from the latest quarter. So there's approximately 23 names trading under 75% of their intrinsic value on the tracker. And although that is high, you know, definitely in the last year, we didn't see that many names in the tracker that are trading under 75% of their intrinsic value. There's approximately about 100 names that we're tracking. So everything else is still a bit pricey despite that market pullback, showing that things aren't really that cheap, but we're now starting to see more and more value. And that's why I've still largely been in a substantial amount of cash. And, you know, I'm looking for opportunities to deploy. You can see that top name, Alibaba. It's the cheapest name in the tracker, and that's why I've been focusing on it so much. As Alibaba starts to trade up and there's other names that replace it, you'll see me start talking about Alibaba less. And if you just go down the list a little bit, notice that I have Intel trading at approximately 100% of its intrinsic value. Now, I will freely admit that I'm not an expert in the chip space at all, but from what I've seen with Intel, I'm not super hot on the name. And so I do believe that it's trading at approximately its intrinsic value, and I do believe that there are serious risks on the horizon. Even someone who's not an expert in the chip space can see that Intel has an uphill road relative to their competition, mainly AMD. And then you see Equifax. That's a name that I've wanted to own for a long time. It's just never come down to where I'd like to purchase it, so it's not there. And of course, Adobe. I'm very familiar with their products. I'm editing this particular video on an Adobe product, which is called Premiere Pro. I really understand Adobe. They did come down recently with a recent acquisition, but it's still not cheap enough to buy. So you can see that there's a lot of names hidden amongst those groups of red that I really wish would come down, and so I'd be able to purchase more and more of them. But it just hasn't happened yet in this environment. But, you know, as the market continues to come down more, you know, as I said in the intro, there's going to be a lot of us value investors that are going to be waiting to deploy capital when there's blood on the streets. Now, the last time that I was fully invested in the market was in March of 2020. Prior to that, I can't remember the last time I was fully invested in the market. I always have some cash on the side, but just March of 2020, I was getting insane deals. For example, I was buying mid-streamers with predominantly all of their capacity under take-or-pay contracts that are yielding 20%. Or I was finding quasi-like government-type companies with 15% yields. And so it was a very easy time to invest, but it's gotten a lot harder as the market's gone up. But I'm going to still continue to watch it. I'm around for at least the next 60 years or so. So we will find opportunities. It may not be today, it may not be tomorrow, but I do feel like the trajectory is going in the direction that we want to see it. And we'll sort of pick things off as they come. And I'm always also paying attention to the options markets as well. If there's some interesting cash secured put opportunities where I'm not comfortable with paying the current stock price for the company, but the cash secured put opportunity gives me a high enough yield, happy to buy it. And you know what? That conservative strategy has largely proved fruitful in this environment, as many people are down in line with the market. So they're down maybe 15-20%. My personal portfolio, I was just repricing it the other day. I'm up around 8% on the year. And if that Activision deal closes, because I'm using some options to play it, the portfolio will end the year at over 30%. But who knows if it closes before the end of this year? Even if it closes at the end of 2023, you know, it's still such a large gain, but I don't know if it'll happen. And even if it doesn't, it's not that big of a deal. Now, as it relates to the cheapest stock on the tracker, Alibaba, I recently did a full 40-minute in-depth analysis of their Q3 results, and I related a lot of those results to what they said they were going to do in the Alibaba Investor Day, which they had in December of 2021. So if you really wanted to get an in-depth understanding of Alibaba, that's the video to check out, and I will link it right here.